Hello, welcome to the Creative Hub. Have you ever wondered where that piece of paper in your pocket or those digital numbers in your bank account came from? Today, we'll explore the incredible story of money, a journey that started with bartering and evolved into the digital world we know today. If you're ready, let's begin. Imagine living in a world without money thousands of years ago. If you were a corn farmer and you needed new shoes, all you had to do was find a shoemaker who had shoes and was willing to trade them for your corn. This system was called bartering, and it was incredibly inefficient. But what if the shoemaker didn't want corn? What if he wanted a goat instead? Then you'd have to find someone willing to trade a goat for your corn, and then trade that goat for the shoes. It was a complete logistical nightmare. To solve this problem, people started using goods that were widely accepted and had an intrinsic value. Salt, seashells, and eventually precious metals, like gold and silver, became the first forms of currency. They were portable, durable, and everyone agreed they were valuable. But there were still problems. How could you be sure if gold was pure? How would you weigh it correctly for every transaction? It was at this point that a truly revolutionary idea changed everything. The solution was to create a standardized unit of value, coins, what we know as metallic money today. This eliminated the need for constant weighing and purity checks. However, as economies grew, carrying heavy bags of coins became impractical. This is why promissory notes, which we now call paper money, were born, backed by a promise of a certain amount of gold or silver held in a bank. Today, our money isn't backed by gold. Our money is known as fiat money, its value guaranteed by the government and our trust in the economy. The power to create and manage this money belongs to a special institution. In the United States, that institution is the Federal Reserve, or simply the Fed. The Fed decides how much new money to print or not print based on the economy's needs. But here's the truly surprising fact. Most of the money in circulation is not physical. What do I mean by that? I can almost hear you asking, how so? When you use your credit card, make a bank transfer, or shop online, you aren't actually using a banknote you hold in your hand. You're simply sending a digital number from your bank's account to the seller's account. The existence of this digital money is based entirely on the records of banks and the FED. In other words, the majority of our money exists as digital data on a computer. So, can the Fed print as much money as it wants? The answer is a clear no, because printing money has a very significant consequence: inflation. Inflation means the silent decline in the purchasing power of money. Think of it this way. If a loaf of bread cost $1 last year, but costs $1.25 this year, that's inflation. Your dollar buys less. The fundamental cause of inflation is too much money chasing too few goods. If the Fed prints too much money, there's a flood of dollars in the economy. Suddenly, many people have money to spend, but the supply of goods and services doesn't increase fast enough. This imbalance pushes prices up and decreases the value of the dollar. This is why the FED has to be very careful with its monetary policy. Money isn't just a tool for buying and selling. It's also a reflection of our trust in the economy and our government. From the struggles of bartering to the complexity of digital banking and monetary policy, the story of money is a fundamental part of human history. So what do you think the future of money will look like? Will cash disappear completely in favor of digital currencies? Share your thoughts in the comments below. And if you're curious to learn more about how the economy works, be sure to hit that like button and subscribe.